Hey everybody, welcome to week 4, informative speech. I thought I would talk a little bit about this week about disability insurance, who needs it and why they need it. The purpose is going to be to educate you guys about the facts of disability insurance and how it can affect you directly. Your ability to provide an income to your family is your biggest asset, and protection is essential. You protect everything else, like your home and your auto. You even have life insurance now after last week's video. So, why aren't you protecting your paycheck? If you had an ATM that sat in your living room that you pushed a button and it spit out money anytime you needed it, wouldn't you insure that ATM? It's kind of the same thing. If you know that you are the primary breadwinner in your family, hopefully you have some plan in place, because according to a study conducted by Kelton Research in April of 2012, 50% of Americans couldn't make it 1 month without their disability paycheck, without a paycheck, before financial difficulties set in if they became disabled, and 1 in 4 Americans would have problems immediately. So who needs disability insurance? A different study published by Milliman Inc. in 2007 said that there is a 3 in 10 chance of disability that will keep you out of work for 90 or more days at some point in your career. A similar study done by the Council for Disability Awareness says that 90% of claims are due to illness, not accidents. So anyone that has a job, whether they are single or have a family, should protect their ability to earn that future income. The standard rule of thumb is to have 6 months of living expenses and savings. Do you? I don't. Could you cut back down? Could you lower your standard of living in order to make that little bit of money that you've got coming in squeak out and pay what you need to pay? How much is available through your employer? Most employer benefits are paid out pre-tax, which means that you pay out your benefits prior to any taxes being taken out from your paycheck. Therefore, the 66% standard disability rate would then be minus taxes from that 66%. Outside benefits that are purchased through an outside company are after tax. Since your paycheck has already been taxed when you pay for it, the full 66% is paid out. Benefits can be stackable, and it's generally recommended that most people carry between 65 and 75% of their regular income. Should you consider extra coverage? Well, it depends. Is 66% of your paycheck going to be enough? The bonus to going with an outside company would be that if you lose your employment for any reason or you change jobs, you're not losing those benefits, having to start over or go through any kind of waiting period. There are both short and long-term policies available. Generally, a short-term policy will pay out anywhere from 1 to 3 years as a benefit period, whereas a long-term policy will pay out more like 5 years or up to age 67, depending on the definitions listed in the policy. There are also, it can be any disablement from any occupation or any disablement from your own occupation. So if you are a surgeon or have any kind of technical training, you may want your disability policy to pay out based on your own occupation. That way, it's not that you can't work at all, it's that you can't do your job. And then it also, policy wording would prevail as far as partial disability. Does it cover if you're partially unable to work or can only work part-time? There are a lot of other factors to consider. How much income should you replace? The more income you're looking to replace, the more expensive your policy would be. Your elimination period, that is kind of like a time deductible. The longer that you are willing to go without a paycheck, the lower your overall premium would be, but the more you would need in savings for that to have any effect for you. The longer your benefit period is, a 1-year short-term policy will be less expensive than a 3-year disability policy. So according to Affordable Insurance Protection, almost half of foreclosures on traditional mortgages are due to disability. So most of the time, 46% to be exact, of foreclosures are due to disability and the primary breadwinner being unable to pay the mortgage. So in your instance, if you were unable to work, could your spouse or partner take care of the bills? Could they pay the mortgage without you? If you put aside 10% of your income every year, if you religiously put aside 10% of your income every year, 1 year of disability could wipe out 10 years of those savings. It's expensive between the prescriptions, the deductibles, the hospital bills, and that's not even taking into account the fact that you don't have any income coming in and your regular bills are still due. A lot of people say that they'll rely on Social Security disability, but Social Security is only available if you have 10 years of working experience, and their definitions are so strict that only 35% of disability claims are ever approved for benefits. And it might surprise you to know that back issues are the number one cause of claims for disability, up to 21% of claims in some studies, followed immediately by heart disease and arthritis. So it really has very little to do with an accident and more to do with health issues overall. So I'm hoping that if nothing else, you've taken to heart that your ability to earn an income is your biggest asset and it should be protected. That hopefully, little ATM analogy made sense to you and you understand why you are so important to your family. And if nothing else, that this little bit of information will help you start a conversation with your loved ones to start putting a financial plan into place, because disability is so common and it's not usually caused by accidents. It's generally caused by an illness. So it's important to protect your most valuable asset, which is always, always going to be you.